Hi, this is James Eng of Old Capital. And for this month's multifamily financing webinar, I chose the theme of survival, or survivor. So outwit, outplay, and outlast. And so let's jump into how are we going to survive to 2025 out there as a general partner? Questions you need to answer. So that's number one. Number two, we're going to talk about the Fed funds forecast. Number three, an update by Metro here in Texas that a listing broker put together, and then opportunities that I see in multifamily investing. And then we'll wrap up with where the different debt options for investing in multifamily are right now. So, all right, survives 25. So the number one indicator typically of a recession is this inverted yield curve. So it's accurately predicted inverted recessions the last 3, 4, 5 times, it seems like. So anytime, let's say the 10-year Treasury is lower than the front of the curve, so federal funds. So let's say federal funds today is 4.75, 10-year Treasury is 3.5 or 3.7. So it's 100 basis points off, right? But in the wrong direction. So most of the time it's going up and to the right. This is the opposite right now. So here you see that it's sort of been inverted since 2022. And so it's sounding the recession alarm. And a lot of people are predicting recession. I think almost everybody's just trying to figure out how bad it's going to be. So that's number one. So that's sort of the macroeconomic that we're going into. All right. So these are questions that you need to answer now as a general partner. All right. And we're going to take these one by one. So you don't have to get them all now, but here's just sort of a high level of where we're going. So, all right. So, number one, do I have a loan maturity in 2023 or 2024? And what options do I have? So, here's the deal that we looked at. It was Bridge Investment Group did the bridge loan. And so that loan was probably around 18, $19 million. And then we sized it up on a Fannie Freddie. So they bought the deal in 2021. We sized it up on a Fannie Freddie, and it's getting to about the same loan proceeds. So they have an option, right? They can stay into that loan for a couple years and then figure out what they want to do. So a lot of people here, because of they bought the deal in 2021, most people have a 3-year loan on their bridge. And so this is going to mature next year. So they have time to 2024, but does it make sense to just maybe do a 5-year with a 3-year yield maintenance and refinance that bridge loan out and just give yourself a little bit more time, just in case the market does soften this year and next year due to a recession? You have that time frame. So a lot of people are moving to just like a shorter term fixed rate right now, just to move that maturity, right? So if you have a shorter term maturity, reach out to us. We can sort of refinance and look at different refinance options for you, where you don't get stuck in a large prepayment. And another thing to look at is that a lot of these bridge loans that were done, they required a rate cap. And so if you sell your rate cap, you'll be in the money and you'll be able to sell that rate cap as well. All right. Um, Number two, so if you have a floating rate loan uh, and your interest rate cap expires, you might have a longer term loan. So Fannie and Freddie both did floating rate loans, but they were 10-year terms, which was great. But then you typically only bought a 3-year replace cap at the beginning, right? And that might have cost you, $50,000 at the time for a $20 million loan. But now you have to replace that cap. So in this one, you're having to replace that cap, and the remaining balance, or what they're estimating to replace that cap, is about 50,000 a month. And so that's based on a strike rate of 2% approximately. And so a lot of people are actually refinancing their floating rate loans into another floating rate loan, but with a higher strike. And so what that allows you to do is drop the cost. So if right now it's about 975,000 for a 2% strike at this loan amount, if you go to a 4% strike, that'll be about 342,000. So your strike rate's actually determined when you actually did the loan. So if you did the loan back in, let's say 2020, it was based on that debt service coverage and that NOI. But if you've gone in, raised the rents, improved the NOI, now you could probably get a higher strike, which will lower your replacement cap costs. So that's option two for this question. All right, number three is, do any of your properties have negative cash flow? And so this goes back to uh, most people on fixed rate debt, they know exactly their debt payment. But the thing that's coming into play right now is these monthly cash escrows. So let's look at this example on the right hand side. You had NOI of 1.4, your debt was about 770,000, your cap escrow was 24,000 a year. Okay, year two, we see interest rates going up, and your interest rate cap escrow went from 24,000 a year to 360,000. Okay, and then now in this year, 2023, your NOI has gone up. Your interest has been essentially the same because you had interest rate cap, but now your interest rate cap escrow is about 1.2 a year, 1.2 million. So you have negative cash flow on this deal. So this is happening on Freddie and Fannie floaters right now. And so people are getting notices in the mail or an email that their monthly escrows might be higher than their monthly debt service. And so what we're doing is refinancing a lot of these guys to fixed rate with shorter prepayment, and then you actually sell your rate cap. So you're going from this negative cash flow situation to NOI of 1.5, your new debt payment of about 1.2 million. And then your net cash flow is positive now, and then you also sell your rate cap, so you're able to get $500,000-$600,000 depending on when that rate cap was purchased and how much time is left on it right now. All right, let's jump to the fourth question. So I think number four goes, what asset management best practices do I have in place to deal with, let's say, lower demand and potentially higher expenses? And so we were at an NMHC at the end of January, and one of the CEOs of one of the largest management companies said 2023 will be the year of expense control. And so how are you going to start tracking your expenses out there? A couple of reports that I work with a couple of general partners here, and the reports that I focus in on are obviously a T12 and rent roll. So that's, usually the byproduct of a lot of these other things. But number one, available units report. So this shows the days vacant for a property, the actual unit, and then if they're ready or not ready. So that's number one. Number two, delinquency. It doesn't matter how many people are in the units, but if nobody's paying, then that's going to impact your cash flow. Your rent roll summary, that's going to show your breakout between floor plans, occupancies by floor plan, and the rents that you're getting. Work orders, I mean, this is going to be very important, especially in terms of retention. Just at the Old Capital Speaker Series, we had JC with Velo there. And, one of the big things to control these expenses is really turnover. And so it's going to be about work orders, getting those done, and retaining those tenants. That's going to lower your vacancy, and it's going to drive a lot of these other items as well. Number five is recent lease assigned. So sort of what you're getting in your lease trade outs is also going to be important as you move, especially on your value add deals. Let's say maybe on Bridge, your recent lease trade outs are going to be huge. And then wrap it up with the finale, T12 and rent roll. So all sort of 1 through 5 impact the last one, which is T12 and rent roll. So we just usually look at T12 and rent roll when we're sizing deals for refinance or an acquisition. But I think if you're an asset manager on your deal, a general partner, you need to jump into these 1 through 5 and really start digging in. And so we're going to look at working with some general partners on the asset management piece. So if you're interested in that, just send me an email. And I think it's worked well in the past couple of years, and just tracking these things and staying on top of them and sort of sharing best practices between general partners. So let me know if you're interested in a group like that. All right, so that's sort of the 4 questions that you have to ask yourself if you're a general partner. So let's just hit those real quick. If you have a loan maturity in the next 2 years, what are you going to do about it? If you have a floating rate loan, when does my interest rate cap expire? And then in terms of if you have negative cash flow because of escrows, how are you going to change that or feed it? And then last one is on the asset management side. Number 4, what best practices do you have in place? Are you managing that on a month-to-month basis? All right, so let's jump into this forecast, because I don't think anyone knows where this thing is going, but let's just look at where the market makers are forecasting. Let's start on the left-hand side. So here's the federal funds curve, or sorry, here's the SOFR curve. And then down here on the bottom left is what they're expecting in terms of hikes. So we're right here, sort of 450, 475 right now. In March, they're expecting another 25 basis points. So after that March one is where it's sort of, there's different degrees of how much more these guys are going to hike. And so the market might have another one baked in May, and then potentially another one in June now. And this one in June just sort of popped up really because of CPI. So CPI came in a little bit higher than expected for January. This was reported in February, but for January, it came in a little bit higher. And, you know, economists, whether it's JP Conklin with Pinsford or Casey Conway is going a little bit higher. He's thinking Fed's got to keep going on this rate. JP thinks it's going to sort of smooth out here for a little bit, but everyone's just waiting for this pause, because as soon as they pause, it's going to give you a lot more leeway on your rate caps. So the Fed is really looking at two things. Number one, inflation, getting that down to 2%, but then they're also looking at unemployment. So unemployment has still remained stubbornly low at sort of 3.4%. And so until they see inflation down to 2%, and then unemployment up a little bit, I think they're just going to keep on cranking, and hopefully we see a pause this summer is sort of what the market is expecting. All right, 10-year Treasury is just sort of back up to about 3.7 right now. It sort of took a little bit of dip at the beginning of the year, but the recommendation I have for people is, if your deal works now, like if you can refinance to a fixed rate, if you can refinance to a float and get a higher strike, if you can do those things, you know, be in position, right? So if your cash flow is there, great. Get yourself in position, whether it's doing the appraisal, doing the engineering, environmental, put some money down and be in position, because a lot of these reports can last, you know, 3 to 6 months once you do them. And then if 10-year does drop down, you know, we get a low CPI rating or something like that, then in a month, then it might drop down more, right? So you know, nobody knows on this 10-year Treasury, and so you just have to be in position though. All right, so what are we seeing sort of on the apartment side? Rents essentially stayed flat. I think they ticked up. You know, they were going down a little bit, sort of with the seasonality of the fourth quarter, and especially demand. You know, when we had Greg Willett this past week at the speaker series, you know, demand was pretty light, sort of back half of 2022. And now in January, people are seeing a little bit more demand coming back. And so, you know, Marcus Millichap put out a pretty thick 70-page PDF on what they're seeing in the market. Obviously, on the apartment side, I think the big story really is the new supply coming online. But then, you know, the offset to that is the relative affordability compared to single family. So wanted to touch on a couple of the markets here in Texas that we see a lot of deals in. Let's just start with Austin, you know, the darling of everybody. It came in at number 6 for Marcus Millichap this year. The big thing, construction. So 18,000 units being constructed, 6% of inventory, which is pretty high. So vacancy is going to move up, but they still see rents about 4%. So, you know, Austin is pretty tech heavy. They're thinking that even with all the tech layoffs, that Austin's going to be okay. There's still a lot of, you know, high white collar worker income jobs there. So that gap between apartments and single family is huge in Austin, one of the largest in the country. All right, let's go over to my hometown, or my new hometown, DFW. This one came in at number 2. And a couple things, I would say it does have probably the most units under construction, are about to deliver 25,000 units. But just the amount of jobs coming in, just the past couple years, I mean, just phenomenal numbers. I think DFW is number 1 in employment growth since sort of leading out of the pandemic. So I think the vacancy is going to take up a little bit, but it'll be closer back to normal, sort of 5-6% vacancy rates. And then, you know, just a lot of demand and a lot of different employment drivers here in DFW. So that's why it came in at number 2. Let's go down to Houston, my original hometown. And they actually saw vacancy moving up the most, right? So they see vacancy moving about 130 basis points up. They have 16,000 units coming online with only 20,000 new jobs. So a little bit light there. And so just the absorption is not going to be there on the Houston side. And in San Antonio, this probably it had like negative absorption in 2022. And then their vacancy is also moving up about 130 basis points, and 6,000 units are coming online, which is pretty high for this market. So that was the highest since 2017. So a lot of new markets, or a lot of new units coming in San Antonio. All right. So if you didn't know my background, born and raised in Houston, that's actually where I was born. Went to school in Austin, then moved up here in DFW since 2006, was an underwriter for GE Capital up until 2015, and then 2015 to today, focused in with Old Capital, originated about 1.4, 1.5 billion in loans, and then invested in a number of properties across all 4 metros here in Texas since 2015. All right, so this is what we've spent a lot of the webinar about, is really do not become a foreseller, right? So if you need to do a cash and refi from a short-term bridge to agency, whether that's rescue capital, pref equity, figuring that out, raising the money from the LPs, just to make sure that you're not a forced seller. So, there's very limited inventory on the market right now. I think most people the cap rates have moved 100, 150 basis points from last year. So it's almost like too fast of a movement for people to adjust to at this point. So your job is to be prepared for opportunistic purchases. So why multifamily still? I usually keep this chart in there, and I like this chart on the upper right. This shows sort of the gap. So between monthly mortgage payment and then rent. And so in Austin, I mean, that gap is huge, 3,000 a month. In Dallas Fort Worth, 1,800 a month, and even in Houston and San Antonio. So this is a combination of just single family pricing going up anywhere from 40 to 50% since 2020. So the price of the house is expensive. And then also to get a loan on a house right now, you're still looking at a 6% interest rate on a 30-year fix. So the combination of those two things has just driven the cost of being in a house super high. And so what that's doing is expanding the amount of time. Most time, people would, go to school, go to college, come out of college, work, stay in an apartment for a couple of years, and then they buy a house. But now it's like, I'm in an apartment for like 10 years or 15 years before I buy a house. And so that starter home, that first home, is a lot harder to get into right now. And then the second piece is really just the shortage overall of multifamily housing. So NMAC, that was probably the most quoted thing. That's what everybody talks about. And I think it's really around just the affordable housing piece. So the A stuff is going to move, is still going to be, have a little bit of softness, but the B and C stuff, there just really isn't enough of that housing. And so if you look at this map in the bottom right, it's like, all right, where do I want to be in terms of where adults sort of 20 to 30, 35 want to be, and it's in the green dots, right? So you really see the Texas Triangle, DFW, Austin, Houston, San Antonio. You see the Charlottes of the world, Nashvilles of the world, and then sort of the Southeast and Florida. So it's really, the Texas markets, and then really the Southeast markets. That's where the population is moving. That's where the young adults are moving. And so in terms of buying multifamily, that's where you want to be. All right. So where else do we see some opportunity? So some of these guys who are not able to put their house in order, they're going to be motivated sellers. They're going to have to go. They either didn't have interest rate caps, they're having cash flow sweeps, they're just over levered. So some of these deals, we size them up. They're not able to get, let's say the bridge loan amount on this deal was 28 million. If you look at the financials, it might size to a $20 million loan right now. So they're $8-9 million off on their refi. So they're just going to have to go. They're just going to have to sell unless they can cash flow this thing for a couple years and kick the can. So that's going to be opportunity on the bridge side. There's going to be opportunities for loan assumptions. So this is an example of a deal. The interest rate's about 4%, which is good, but the occupancy is 60%, right? So you're looking at the deal, you're saying, all right, $28 million purchase price, $23 million loan. That's pretty good. It's 80% plus leverage. But then you have to remember, you got to bring in the capital yourself. The lender's not going to do that. You're going to have to bring in an interest reserve to pay the debt service while you get these units up. There's going to be closing costs, working capital. So yeah, the initial down payment looks low, but you're going to have to raise all this money for additional things as well. So, but loan assumptions are a good option out there for properties that are struggling, or even properties that maybe they've just held it for 5 or 6 years and they just don't want to be in the deal for 3 more years or 4 more years. So loan assumptions are a good option for you out there right now. All right, where else are we seeing opportunity for new buyers? I would also say the floaters. So we've talked about this. So this is a list of all these deals that were done on essentially Freddie floaters. And, these strike rates, these guys are having to replace these caps, and it's costing about 5% of the loan amount. So imagine let's say you took a $10 million loan, and then all of a sudden you need to come up with $500,000 to replace your cap. And so that's got to come from somewhere. And majority of the time, it's going to be escrowed on a monthly basis. So some people are going to have to reset their caps or go back to LPs to raise this money because the property is not going to be able to sustain that monthly cash flow. All right, so here's a snapshot of the loan options out there right now, sort of the rates that we're seeing. So bank loan, Freddie, Fannie, and the non-recourse bridge. So we're going to spend a slide on each one of these and sort of the strategy. All right, recourse bank loans. So this is really tied to prime. So prime right now, every time the Fed raises, so the Fed raised 25 basis points at the beginning of February, it's now at 7.75. So it might go, to 8.25 here in the next couple months. But this is really what your bank loans are tied to. So the good thing about bank loans is that it's fixed rate. You don't need an interest rate cap. You typically get a pretty good step down prepayment or limited prepayment. It's quicker approval, but it is recourse to you as the borrower. So still doing some recourse bank loans out there, especially for smaller deals. I would say in that $5 to $10 million range or lower. And then if Fannie and Freddie just are not getting to that leverage point that you need, so let's say you're getting to only 50% on a Fannie and Freddie and you want 65 or 70%, the bank loan will do that for you. All right, so in terms of Fannie and Freddie, the one thing that I wanted to touch on, Fannie and Freddie, is these guys are the backstop. These guys are the backstop for multifamily, and they lend $80 billion a year. Typically, and 2022 they had 78 billion and they couldn't get the money out. So this year they're going to try to get the money out. They have 75 billion each, and a lot of these guys have fixed rate options. They have longer term non-recourse options. I mean, it really doesn't make any sense. You have non-recourse debt available to you at 5.5, and then recourse bank loans at 7.5. So if it can fit, Fannie and Freddie makes sense. One thing I want to caution you against is last couple of years, a lot of people have used bridge loans, and they really haven't had to go to Fannie and Freddie. But now, as bridge lenders are gotten a little bit more expensive, they pulled back a little bit, and the rates are higher. A lot of people are going back to Fannie and Freddie. And the thing that they don't know is they might be on A-check. So A-check is really a list that Fannie Mae has. And essentially, if you're on that list, because your property hasn't either performed or the condition of your property hasn't been as good as it should be, then you're on that list, and Fannie and Freddie aren't going to give you a new loan. So making sure, you might think you're going to go get a refi with Fannie and Freddie, but you're on that list. And so making sure that you're not on that list, taking care of your property in order to do a refi into Fannie and Freddie. So that's this was the loan that we did. This was on acquisition out in Longview. So this one was probably around 55% levered. I think they wanted to not only just sort of fix the rate, get the 3 years IO. This is a longer term hold for this group, and they had plenty of equity to put down. So the lower leverage wasn't a big deal. It's sort of cash flow right out of the beginning. All right, in terms of bridge loans, bridge loans are still getting done. I think in terms of, where pricing is, We're doing some fixed bridge at 8 to 9%. Spreads on floating are still probably around 4%. So you're all in still 8 to 9%. But if you have a fixed rate, you don't need the interest rate cap. And then also on your exits, you're going to be hitting 9 to 10%. So this is really for deals where you have a deal that's really all classic, and then you have room to bump the rents anywhere from $200 to $300 on the deal. So this is a deal bridge loan that we just financed, not a recourse bridge. It was fixed rate around 8%, and then it had 3 years IO. And so they're going to come in. They want a little bit more leverage. Fannie and Freddie were probably around that 50, 55%. This went up to 70%. And then it's going to go in and pretty much try to upgrade the interiors of the units, and then really push rents probably about $200 or $300 per unit. All right, so getting the agency, we talked about this. I would say the main thing on this one is a lot of people are like, well, I don't want to fix the rate and then get stuck in it and then have a big prepayment penalty. So my suggestion is really do a shorter term. So do a 5 or 7 year, and then you can usually do either a 5-year term, 3-year yield maintenance, or 7-year term, 5-year yield maintenance to really bring down that prepayment. And so if you're in the deal for a couple more years, your prepayment is going to be pretty minimal at that point, and then you'll be able to sell your interest rate cap as well. So the most important thing right here is really get into that 125. So focus on your net rental, focus on your expenses. The thing you have to remember is when you do a refi, we cannot use pro forma expenses. We have to use your actual expenses. So the only thing that we're going to pro forma is really your new insurance number and your new tax number. All right, so let's get into so why are people calling us? Here's a chart of the 10-year Treasury. It goes up, it goes down, it goes up, and depending on the cycle, depending on where you are, you're going to need people who are experts in Fannie and Freddie. You're going to need experts in bridge. You're going to need what do I do on a floating rate? What do I do on non-recourse versus recourse? What if I need to go to HUD? So all those things, that's what we're experts in, right? So that's what we help you up, sort of give you educated before the deal, whether it's the podcast, whether it's speaker series, lunch and learns, YouTube. During the deal, we're representing you, the buyer, as a second set of eyes. And then after the deal, we want to make sure you succeed, right? So whether it's asset management, loan servicing, highlighting you, whether it's the podcast, the conference, things like that. So that's why people use us on these deals. And so last year, I guess this was for 2022, they had us down for about 1.4 billion. I think this was off a quarter or so, which was number 18 in the nation, which was pretty good. So we're building our way up there. For the calendar year 2022, we closed about 1.2 billion in loans across the nation, which was about 13,000 units out there. And so a couple upcoming events, if you want to come out, go to Old Capital podcast to register here for the speaker series. We'll put a link in the comments as well, or in the description. And then we also have a charity event called Strikeout Homelessness, which is a bowling tournament, which we'll have over in Plano, April 6th. So you can go to oldcapitalconference.com to register for that one. But in terms of next steps, if you like this video, definitely like, comment, share this video, subscribe to the channel. And then if you need help with a specific term sheet on a loan, definitely send me T12 rent roll, OM, whisper price, and we'll get that for you. Or reviewing a deal. So if you're a limited partner looking at a deal, you just want to ask some questions about a deal or get feedback on it, let me know. And then if you're interested in joining Old Capital, if you've made it this far, you're interested in joining Old Capital, send me an email with your resume, and then we can set up some time to talk. Thanks a lot, guys.